I lost $47,000 in a decade. Not by gambling, not by crypto. I lost it by doing absolutely nothing with my money. And the worst part? I thought I was being smart. Every single year, inflation ate 3 to 7% of my savings while I just sat in a bank account earning 0.01% interest. I did the math. You should too. By the end of this video, you'll know the exact 3 mistakes that keep ordinary people broke and the simple fix that changes everything. Stick around. My name doesn't matter. What matters is that in 2013 I had $18,000 saved up and I felt proud. I was 27. I had money in the bank. I was doing fine. Or so I thought. A financial advisor friend sat me down 10 years later and showed me a spreadsheet if I had just invested that $18,000 at a 10% average return. The S&P 500 historical average, I'd have $46,687 today. Instead, I had $19,800, a decade of my life, and I beat inflation by exactly $1,800. That was my wake up call, and mistake number 1 is why it happened. Number 1. Treating your savings account like an investment. Here's what nobody tells you in school. A savings account is not an investment, it's a waiting room. Meet Marcus. He's 27, earns $3,000 a month, saves $500 of it religiously every month. His family is proud, his bank is thrilled, his future self, not so much. At 0.5% annual interest, Marcus's $500 a month over 30 years grows to about $196,000. Sounds good, right? Wrong. Adjust for 3% average inflation, and his real purchasing power is $107,000. Now, same Marcus, same $500 a month, but he puts it into a simple index fund averaging 10% annually. After 30 years, $986,000. Almost $1 million. Same money, different vehicle. The lesson is brutal but simple. The stock market has averaged 10% returns for a century. Savings accounts average 0.5%. Keeping your money in savings long term is a slow financial leak. The fix? Open a brokerage account today. Fidelity, Schwab, even your local bank's investment arm. Set up an automatic monthly transfer of whatever you were saving. 1 hour of your time. Now, mistake number 2 is sneakier. It gets smart people. It got me. And it might be getting you right now, even if you think you're already investing. Number 2. Picking individual stocks when you have no informational edge. Here's the uncomfortable truth. 90% of professional fund managers fail to beat the S&P 500 long term. My colleague Jake spent 3 years obsessively researching stocks. He read annual reports on weekends. He followed 12 analysts on Twitter. He put $25,000 into his stock picks. After 3 years, Jake's portfolio was up 18%. Feels great until you realize the S&P 500 was up 37% in the same period. He worked harder for a worse result. Spiva Report 2023 over 15 years, 92.2% of large cap fund managers underperformed the S&P 500. These are people with Bloomberg terminals and PhD analysts. You and I don't have a chance. This doesn't mean don't invest. It means don't try to beat the market. Join it. Index funds like VOO, VTI, or SPY hold all 500 top companies. You win when America wins. The fix? Take 80% of your investing money and put it in a single broad index fund. Keep 10% for individual stocks if you enjoy it. Keep 10% in bonds or cash. That's the lazy portfolio. We're halfway through, and already you know more than most adults who've been earning for 20 years. Mistake 3 is the one that even people who invest still get it wrong. Mistake number 3, not understanding the fee problem. A 1% annual fee on your investments sound tiny. Over 30 years on a $100,000 portfolio, it costs you $180,000 in lost growth. Not a typo. Sarah invested $200 a month for 35 years through her bank's managed fund. It charged 1.8% per year, totally normal for managed funds. She retired with $380,000. Her coworker Lisa did the exact same thing, same $200 a month for 35 years, but used a Vanguard index fund, charging 0.04% per year. Lisa retired with $690,000. Same amount of money, same time period, same market conditions. The only difference was 1.76% in fees per year. That fee gap cost Sarah $310,000 in retirement money. Always check the expense ratio of any fund before investing. Vanguard and Fidelity index funds charge as low as 0.03%. Your bank's mutual fund probably charges 10 to 60 times more. Go to your fund right now. Google the name plus expense ratio. If it's over 0.5%, you're probably overpaying. ETFs like VU charge 0.03%. That is the difference between retiring at 60 or 70. Let me take 60 seconds to show you why all 3 of these mistakes compound on each other. Literally. Compound interest is the 8th wonder of the world. Einstein may or may not have said that, but it's true. $10,000 invested at 10% for 10 years. $25,937. For 20 years, $67,275. For 30 years, $174,494. For 40 years, $452,592. The money isn't just growing, the growth is growing. Here's the brutal truth about time. If you invest $10,000 at age 25, it becomes $452,000 by age 65. If you wait until 35, just 10 years later, that same $10,000 only becomes $174,000. Waiting 1 decade cost you $278,000. This is why the best time to invest was yesterday. The second best time is right now. Let me tell you about a man named Ronald Reed. He was a janitor, a gas station attendant from Vermont. He drove a used car, clipped coupons, and lived simply his whole life. But he had the secret. Ronald Reed spent decades quietly buying blue chip stocks and never selling them. No financial advisor, no fancy strategy, just patience and consistency. Year after year for 50 years. When Ronald Reed died in 2014 at age 92, his estate was worth $8 million. He left $6 million to his local library and hospital. The secret? He just bought good companies and never sold. Ronald Reed's story destroys the myth that you need a high income to build wealth. You need time, consistency, and not touching your investments. That is the whole formula. I know what you're thinking. But what about market crashes? What if I invest and it drops 40%? Valid fear. Let me show you what happens when you panic sell during a crash. In March 2020, the S&P 500 dropped 34% in 23 days. The fastest crash in history. Millions of people panic sold. By August 2020, 5 months later, the market had fully recovered and then some. The people who sold in March 2020 locked in a 34% loss. The people who held, or better yet, bought more, were up 15% by the end of 2020. Same market, opposite outcomes based on one decision. JP Morgan Research, If you missed the 10 best trading days in the S&P 500 between 2002 and 2022, your returns dropped from 9.8% annually just to 5.6%. Those 10 days were mostly during market crashes. Timing the market beats timing the market every time. Every decade, every asset class. The math always wins. Your emotions are the enemy of your net worth. So here is your complete action plan. The one I wish someone had given me at 22. Step 1. Open a brokerage account this week. Free options: Fidelity, Schwab, or Robinhood for beginners. Step 2. Set up an automatic investment. Whatever amount, even $50 a month. The habit matters more than the amount right now. Automation removes emotion from the equation. Step 3. Invest in one of these three. VU, which is the S&P 500 ETF from Vanguard. VTI, which is the entire US stock market. Or VIXUS, if you want international exposure too. Step 4. Don't check it every day. Seriously, studies show investors who check portfolios daily perform worse than those who check monthly. Checking equals emotional decisions equals bad returns. Step 5. Increase your contribution by 1% every year. If you start at 5% of income, go to 6% next year. By year 10, you're at 15% with barely noticing the difference. Bonus lesson. Before you invest a single dollar, make sure you have 3 to 6 months of expenses in a high yield savings account, separate from your investments. This is your don't panic fund. Without an emergency fund, you will be forced to sell investments at the worst possible time. When life hits you and the market is also down, happened to millions in 2008 and 2020. Here's the final mindset shift you need. Investing isn't for rich people. It's how ordinary people become wealthy. The stock market is just a machine that converts patience into money. Warren Buffett made 96% of his $100 billion net worth after age 65. Not because he's a genius, because he started at 11 and never stopped. The superpower is time plus consistency. Let's recap. Mistake 1. Keeping your savings in a bank account instead of investing it. Mistake 2. Trying to pick individual stocks instead of buying index funds. Mistake 3. Ignoring fees. The fix for all three: open a brokerage account, automate monthly contributions into a low-cost index fund, and never panic sell. That's it. 3 decades of financial research in 3 sentences. If this video changed how you think about your money, even a little bit, hit subscribe. Every week, I break down one financial concept that takes years to learn, but only 10 minutes to understand. Hit the like button if you found out something today you didn't know before. It generally helps this channel reach more people who need to hear this, and they do need to hear it. Links to everything I mentioned are in the description below. Brokerage accounts, the best index funds, and a free compound interest calculator so you can run your own numbers right now. Don't wait for a perfect time. Don't wait until you earn more. Don't wait until the market is better. The market is always going up in the long run. The only risk is waiting. See you next week. Your future self is already thanking you for watching this today.